you have been very vocal about your desire to raise rates, that you think that the inflation has been too hot for too long. Have you heard anything at this meeting that changes your mind?
Well, the meeting starts in earnest this morning with the chairman's speech, and that'll be the kickoff. The data that I've seen since our last meeting has been, to me, very much in line with the picture that I was seeing before. And of course, I'm setting my policy views based on the forecast of where I think where I think the economy is headed, rather than where we were over the past several years. But we've been missing on our inflation target for more than 5 years. My forecast is that we're going to continue to end this year around 3% inflation, and by the end of 27, we'll hopefully get down to the mid 2.5s, the mid 2%. But that's not meeting our 2% objective. So to me, there's no tension in our mandate. We've got an employment picture that's right around my estimate of maximum employment. It's been stable and in balance for the past 12 months, and we've been missing on the inflation side. I don't see restrictiveness in the markets. When I talk to people in the capital markets, what I'm hearing is that capital is free-flowing. Investors are looking to put more capital to work. Businesses are looking to make bigger investments. And so I think we need to put some restriction into policy. And so I believe it's time to act for us to do that. The longer that we wait to get inflation under control, the more pain is felt by everyday Americans, and the more difficult it may be for us to ultimately get it back down.
We were talking last night about the meanings of the word reaction function, and some of our colleagues were saying, well, that's kind of a fancy name.
Super technical name. Mathematical formula.
What is it that Kevin Warsh is not doing? I mean, how do you define what Wall Street is looking for, and how do you put your own views into that?
Well, I can't tell you anymore what Wall Street's looking for, because now I'm on the policymaker side. I'm no longer on the market participant side. But I can tell you I view communicating about my viewpoints as a critical part of the job. I think talking to the public, listening to the public, hearing what they're experiencing, hearing how they're seeing the economy unfold is a critical part of what I do every day. And I need to help put my views out there so that businesses and households can make better informed decisions. I like to tell people when new data comes in, how is that going to change my perspective? How might that change the decisions that I and maybe my colleagues are going to make? Because I feel like that will help them to manage their businesses and their household finances.
Well, when you look at what the chair might have to say today, kind of the bottom line question for other members of the Open Market Committee is, how do you feel about the idea of not giving forward guidance, and particularly given your background, having the bond market tell the Fed what it thinks is happening in the economy?
Well, the markets are definitely one component that I look at. Financial conditions and FCI indices are something that I spend time looking at to get a sense of how monetary policy is transmitting into the real economy. But having spent 30 years in markets, I can tell you that market participants tend to be focused on making money for themselves and their clients. And they do that by betting on what the Fed will do, not what the Fed should do. And so I think markets are an important complement, but not a substitute for the Fed and for us taking action.
You're underselling yourself. 30 years, you were sterling in the repo market at Goldman Sachs. There's no one in the history of the Fed that understands short-term paper like you do.
Well,
you got it down. But it's true. You undersell yourself.
I think we have a lot of experts. The staff is incredible at the Fed. That has been one of the most
I will agree on that. Plus, you're out of Cleveland Fed, where you invented in 1983 how we look at inflation with the Cleveland series. Do you still see trust in the market before and after this speech? And the litmus paper, the narrowness of the repo market, do we still see trust in what we're doing?
I think our credibility comes from our ability to deliver on our commitment to the dual mandate. And we are committed to delivering on bringing inflation back down to target.
So this is critical. Ed Yardeni publishing, I was literally on, you had the Gulf Stream, sorry. I was coming out United slow motion. And Ed Yardeni published that, look, where nominal GDP is, we have plenty of room. Let's not fear it. Beth says raise interest rates. Let's raise them because we're nowhere near nominal GDP. Discuss that dynamic.
I think what I'm seeing is that there's not a lot of restriction in the economy. You see businesses going out and raising lots of capital, trying to make new investments. That is good for growth. That can be helpful. But as Ed Yardeni points out, we've been seeing GDP growth coming in above what I think of as kind of long-term averages. When you have that kind of growth, that can put pressure on inflation. That can put pressure on people chasing prices higher. And what I hear when I'm out in the district is I hear from businesses that they're seeing their input costs go up. I was talking with a auto parts manufacturer in Northeast Ohio who was telling me he's seeing double-digit inflation in some of his input costs. He's trying to pass those on, but it's hard to get those increments to go through.
Do you actually see signs of froth in the market? Things that actually are excesses that need to be taken out?
That's not what I'm focused on from a policy restriction perspective. It's more about getting inflation under control.
But I guess that the question is, what exactly would raising rates do if it can't necessarily affect the price of oil, it can't necessarily affect the price of tariffs, and frankly, it's not exactly going to curtail AI borrowing if there is all of this backlog that we're seeing from the likes of NVIDIA and other semiconductors?
We have one blunt tool. We have interest rates. That is our main policy tool that we have. We have the balance sheet, we have our communications. That's kind of the full suite. But primarily we use interest rates. And so when I see an economy that to me seems like we've got inflation too high for too long, what monetary policy would tell you to do is to raise interest rates.
Do you think that interest rates are still the primary tool of this Federal Reserve, given some of the questions around exactly what Fed Chairman Kevin Warsh plans to do?
I think they're the clearest, most transparent, easiest to communicate tool that we have. I think we have a long history in knowing how raising interest rates or lowering interest rates can impact the economy broadly. The balance sheet that we have today is the confluence of a lot of different things that have happened over time, starting back in the GFC. It's, both some amount of QE that happened, so actually policy when you're at the zero lower bound. It's some amount of plumbing, of making sure that you've got ample reserves in the system, and it's some amount of market functioning purchases. So all three of those have sort of gotten us to where we are today. But we don't really know a lot about how changes in the balance sheet will flow through into the broader economy.
I know you won't talk about what other members of the Open Market Committee have said, but when you start doing a count of who said what, you get a pretty divided committee. And I'm wondering, we get the CPI report on September 12th. I'm wondering how close a call the next meeting is on the 16th. Because we seem to be hanging on every inflation report that comes out. If we get a bad CPI, do you think maybe that moves the needle on September?
I walk into every meeting with an open mind, and I think my colleagues do as well. What's important to all of us is that we're squarely focused on the data that's come in, the stories that we're hearing from around the district, and making sure that we're setting policy to really support the American public and support growth overall.
Well, I got to ask you this question, too. October 28th, 5 days before the midterm elections, is that really, in effect, off the table because it's too close to the elections?
I will give you the exact same answer. Every meeting is, I walk in with an open mind, and every meeting to me is live.
I look at this, and you were weaned at Stanford, you drank the John Taylor Kool-Aid. Are we slipping away from rules-based, and do we have a risk of an unanchored moment?
Rules are very helpful. They're helpful for giving you guideposts of how you should set policy, but they're not the only thing that I look at. They're one of many things that I look at. I look at the hard data that's coming in. I travel the district extensively to make sure I'm getting firsthand information about what's going on, because that gives me a better viewpoint as to what's happening down the road. And the rules are something as a guidepost that I can use to help think about.
There's any number of fossils, we'll say, and there's a number of fossils here assembled. We're just back to normal interest rates. Respond to that for the younger crew. It's like, OMG, 2-year, 10-year, 30-year, they're higher yields now, let's panic. I'm like, really?
Yeah, well, I share that same view. I mean, I grew up in the markets in the 90s, and in the 90s, you had interest rates between 3 and 6%, and that felt pretty good. I'm out in the district talking to people who say, gosh, 7-8% mortgages. My first mortgage was 17%.
Exactly.
Right? And so I think you have to normalize. I think when we go back and look at the history, I think what we'll see is that period from 2008 to 2020 was the abnormal part, not this period where we're at today.
A lot of debt got incurred in that time, though, and housing prices are a lot higher. The U.S. now has $40 trillion of debt. How much does that compromise this argument that this may be the normal, but it isn't sustainable for this, at least government, and certainly the spending there?
Well, I have one job, and that's to make sure that we're delivering on maximum employment and price stability. That's the only thing that I'm focused on when I'm walking in the room.
Do you care about the 30-year yield today?
I do look at the 30-year yield. I look at the 10-year yield. I look at the full shape of the interest rate curve because it does give me some sense of, again, where financial conditions are and how difficult or easy it is for businesses and households to borrow.
Do you think that the 30-year yield is rising because of fundamentals, or do you think it's rising in part because of this anxiety, this agita around the Fed's reaction function?
You have access to a bunch of amazing market commentators who can give you much better insights as to why it's rising than I can. But I look at a variety of factors that are driving it, and I think there's a confluence of expectations of what our policy is going to be, expectation of how persistent inflation is going to be, supply and demand forces at play. All of those, I think, are come into play.
President Hammack, have you seen any bears yet?
No, but my kids did yesterday. They were in Yellowstone, and they got me a great video of a bear kind of nosing around in the bushes.
Aww.
And I'm hoping not to see any more.